Good morning. Welcome to Bazaar Morning Call. I'm Lata, and with me, as usual, Anuj and Sonia. Well, globally, there is a risk-off. Let's get away from RBI for just a second. The risk-off has taken the favoured FANG stocks, and Anuj has been worrying about that for a long time. Now that the heart of investor favourites has been attacked, we should be prepared for a bit of risk-off, and that's spread to Asia as well. Let's see how Indian markets fare. Considering such a big risk-off, risk aversion wave, I don't see how we can escape it. Okay, what about our own local situation? I think the RBI board meeting clearly ended up in, I would say, a 4:1 victory for the government, and that's how it would be. It does leave RBI considerably weaker. It makes RBI susceptible to dictation by the board, and a board that is not composed by its composition to dictate to RBI, but that's how the matter turned out to be. Immediately, resignations have been avoided. So for the market, that's a very big relief. At least changes are going to be incremental and not accidental. So that is a very big relief. And there will also be relief for public sector banks because there is a reduction in capital by 0.625%. So that also will be positive. I mean, I'm looking at the green areas in the banking sector, and the red areas could be NBFCs. I did not expect a line of credit, but I'm given to understand the market did expect. So perhaps that would be the area of red. But what happened yesterday is not a question of what was red and green for the market today. In the longer term, one would have desired independence for RBI a little more, and certainly independence from the board. If the government dictated, it's another thing. The board is not composed to dictate to the RBI. That is an institutional loss. For the markets, it's not an immediate worry.
Okay. Hi. Good morning, Lata. Good morning, Anuj. So finally, that meeting is out of the way. The market can perhaps move on. What the market did do yesterday was conquer the 200-day moving average of 10,754. So a lot of good things happened. And as you said, no high-profile exit, a relatively amicable outcome, perhaps will give a bit of a relief to the street from the RBI, that is. But the big news from yesterday was the FII buying. There was more than 1,100 crores of buying in the cash market. There was big delivery-based buying in a lot of large-cap names like ITC, Reliance Industries, etc. So now the large caps are sort of supporting the market. The only question we're asking is, will global cues dampen sentiment? I mean, FANG stocks are now in bear territory, so, down 20% from their one-year highs. And even the, markets like Japan have been under quite a bit of pressure. Anuj, morning. This has been a buy on dips market, as you've been saying for the last many days. If we do get this dip because of global cues, you think it would be a buying opportunity, or will it be sketchy because, this week is truncated? You have the US market shut on Thursday as well for Thanksgiving. So people may not want to take that conclusive call.
Yes, Sonia, good morning, Lata morning. The issue with the market is that the markets had a big one-way rally from 10,000, 10,700. And honestly, the market had scant regard for, this whole, issue that was playing out between, the RBI and the government. In fact, the rally actually picked up steam on the day we thought that there's going to be a big problem between RBI and the government. And from that point on, it's just been a one-way rally, and our market has actually outperformed the global markets. Perhaps with this now out of the way, you've reached some kind of culmination of that rally. That is my basic premise, and we are also close to 200-day moving average. The market is going to be volatile today. There's absolutely no doubt about it. Ingredients are in place for the market to have some kind of bounce from the lows, because the trend is so strong. So first dip normally in a strong uptrend does get bought. So I won't be surprised if today, you have 50, 60 point gap down. At some point that is bought, and perhaps at some point the index tries to make a move into the green. It's possible. But the problem would be that with such global environment, there's normally a second dip. And that, I think, is going to be important to see if that gets bought or not. But this point on FI buying is very interesting, because what it's telling you is that there's been a bit of a tactical move from developed markets to emerging markets, and in that we are participating. And a lot of non-banking heavyweights are looking good. The Bank Nifty had already had its rally. Yesterday, the way Reliance rallied, ITC rallied, Larsen and Toubro rallied, and we'll discuss it in top 10. For me, ITC was really the stock that led the market yesterday. That's looking good. Just one worry point that we discussed over 2 or 3 days is the mid-cap market, because that's showing signs of distribution. The mid-cap rally is poor. There are more stocks hitting 52-week lows once again. That way, you have to be a bit cautious of that part of the market. But right now, the market's not giving you any signs that the rally is over. Today's perhaps going to be one of those days where there's going to be a dip. You should buy that, because that's been the market's verdict, that if you buy the dip, you make money. But if the market gives you a verdict that the rally itself is over, perhaps then you get out. But otherwise, follow the market's trend, which has been to buy the dips.
No, I take your point that, we don't know whether this risk-off is going to be a tidal wave which blows us away, or whether this risk-off is a risk-off for developed markets, and actually money is moving to markets like India, because the November data clearly shows that EMs have done well, and India, being a beneficiary of lower crude prices, actually outperformed even EMs. So EMs outperformed DMs and India outperforms EMs has been a trend. So we have to see whether that trend is negated today because of this big gale of risk-off that has come, or whether this trend is able to withstand that gale. That is a verdict which we will have to wait.
Okay, well, for now, the MSCI in India index is up almost 7% in this month. I was just looking at that, while the EM index is up only about 3% . But coming back to, the RBI meeting, that long meeting that took place yesterday, the RBI and the government have avoided a direct confrontation, so that's a positive. But what else will the market look forward to?
Yeah, the frontal war is avoided, but the guerrilla war will continue.
Yeah, okay.
That's how it looks, and that's why all of them are postponed. For instance, RBI's capital. Until now, RBI's capital, whether it should be given away, was decided by an RBI nominated committee. In 2013 or 14, it was Mr. Malegam. Before that, it was Usha Thorat. Before that, it was Mr. Subramaniam in the 90s. Now it is going to be an RBI government committee. Now, we don't know. It's quite possible that the members of that committee are above board. But the point is the initiative has slipped out, and capital definitely, could also slip out. So to that extent, it's a loss for RBI. But the more important loss comes in... MSME, I think the RBI would anyway have given. There are many instances where the Reserve Bank has given special packages, and they're going to design the package. They will ensure that all riffraffs don't get it. They will put some safeguards in. So that's not a big worry at all. That was anyway needed, perhaps. It is the capital part. The capital part has gotten postponed by 0.625% of capital. Need not be kept by April. It needs to be kept only by April 2020, not April 2019. So that's a little bit of extra capital which banks were trying to collect. Now they can relax and collect it over 20 months instead of over the next 6 months. That's a relief, and it's a big relief for banks like PNB. Now here, the worst part is that this is gotten dictated to by the board, which is not good. This is a technocratic issue, which first of all, the board members are not people who will understand that. Usually board members are a microcosm of society. There have been scientists and artists in the past also. So these should not be the board's agenda at all. And more importantly, it in the future sets the trend that many other decisions can also be decided by the board. So I don't know how rating agencies will look at this relaxation of capital. We have to await their verdict. We are still better than many international jurisdictions, but this would still be a worry. We have to wait for the market's verdict on this. And finally, the Reserve Bank has not given anything special for NBFCs. Yeah. But, it was all, this entire issue is going to be debated on December 14th. That it will not give for NBFCs was expected. I did not even doubt it. But, these things are being left to the next meeting on December 14th, things like PCA governance. They've postponed their, the loss of face, but it's still not a very good outcome for a central bank. What is the PCA rule? What is the capital rule? These are very technocratic issues. The board is certainly not qualified. The board is a borrower. 3 or 4 people in the banks, in the board are borrowers from banks. How can they sit in judgment of how much capital the bank has to keep? It doesn't look right in the scheme of things, but that's the way it is. It's not a very happy day for central bank autonomy.
Okay, well, let's get back to the markets, right? Because it looks like it's going to be a tough day for the markets as well. The Hong Kong market is now down almost 400 points. And the Japanese market, of course, Nissan is the big loser over there. We'll track all of that closely for you. But in the meantime, let's take a look at what our wise experts have to say as we head into trade this morning. Aditya Narayan of Edelweiss says the market will hover around its till the elections. And hence, he would run a relatively defensive portfolio while keeping an eye out for opportunities that expectations swing might throw up. He believes the time to reap these gains will be beyond when the interrupted business cycle comes back to the fore. There's a little more risk appetite in the economy and valuations become a little more generous. So basically, the time is not now. There will be a time when the valuations will look more attractive. The caveat, he says, will be an unstable government, which shouldn't disrupt the business cycle, but valuation generosity, it will.
All right, more opinion coming from Sayon Mukherjee of Nomura. He says, against the backdrop of risk to near-term earnings and valuations, he values Nifty at a target multiple of 15 times on FY20 earnings estimates. And he says their Nifty target at 11,270 implies an upside of 5% from current levels. He remains stock selective, preferring quality companies that can generate higher ROE and are at reasonable valuations and certain turnaround prospects.
Okay, well, there's a lot happening in the money markets, actually. The rupee today closed at a 10-week high, against the dollar. I mean, it's been gaining now, I think, for the 5th straight. 164 is where it's at. Bhaskar Panda of HDFC Bank gives us his view for today. He says the dollar retreated overnight towards the crucial 96 support level, and global oil prices seem to be finding a base now as expectations of an OPEC cut grows. He says low oil prices and a readjustment of FI sentiment has helped the dollar-INR pair. He expects the pair to consolidate within a range of 71.50 to 71.70 for the day.
Okay, and Bhaskar Panda expects the 10-year benchmark bond yield to remain range-bound within a range of 7.75 to 7.80 for the day.
Okay, well, global markets, of course, complete red over there. Here's Nigel with the world view.
Well, that's right. The U.S. markets ended deep in the red yesterday, with the Nasdaq being a relative underperformer with a cut-off close around 3%, telling you that tech stocks, they had a very, very rough ride yesterday. In fact, most of those FANG stocks, they have corrected close around 20% from the recent peak, and that's where we're seeing selling pressure in terms of the Nasdaq. And overnight, all these big names are down anything between 4 to around 5.5% odd in trade. Well, we had some commentary that came in from the Vice President as well, Mike Spence. He says there's no end in terms of the trade war with China. They'll be putting on those tariffs on the $250 billion worth of goods coming in from China. And also, we had not great news coming out in terms of economic data. The home builder data didn't look very, very good. Shifting focus to the European markets, though, those markets as well ended in the red. Renault, that was the big stock that was in focus. The chairman, in fact, the resignation coming in there. So that stock was down close to around 9% approximately. And the peripheral indices as well didn't do very, very well. So all the peripheral indices as well ended with cuts of around 0.5% to around 1.5%. Asian markets, they're struggling early this morning, but the currency space is something that you need to look at. So the dollar index has cooled off to around the 96 odd mark. And in fact, we are seeing some strength on the euro as well. Besides that, we also have Brent crude prices that have cooled down to around the $66.50 per barrel. So good news actually in terms of the currency space as well as crude oil prices cooling down. And the SGX Nifty, a relative outperformer, sitting with a cut of around 0.3%. Back to you.
All right. Thank you very much for that. A little bit of a red, Nigel, but let's see how things pan out for us.